Hi, welcome back to a new episode. So today we are going to discuss one of the important topic that come across very often. That is, if somebody is departing from Canada or leaving Canada and has a corporation, what would be the impact on the corporation if he has retained earning in the corporation? So what would be the tax impact? Let's discuss that scenario in today's discussion. I have Narinder with me. We will be discussing on this very topic. Let's start. The question is when somebody is leaving Canada, has a business, and he has to pay the tax. So, Narinder, why is leaving Canada a bigger deal for business owner than for an employee? This is the question. If you can just throw some light on that.
Yeah, thanks, Waqar. And it touches every one of us because our economic engine is our entrepreneurs and majority, like we are in Alberta and Ontario, that 90% of our businesses or 90% of our economic activities are through small business sector. And pretty much they all counts for almost 95% owning private businesses. But when we think of leaving Canada, this creates a very significant impact because your shares, what you own in your own corporations, are not exempt. And as soon as you think or you leave Canada, it triggers into a deemed disposition and triggers capital gain taxes, and which are significant.
Okay, so that means that if somebody is leaving Canada, owns a share in a corporation, he has to sell the share and pay tax on that.
Yeah. And as we previously recorded and made our clients aware that even if you do not sell, the government deems it sold as soon as you depart from Canada, which means you haven't sold anything yet, but still in the eyes of law, it considers sold and you pay on the gains that you have accrued since you have owned this corporation, all the retained earnings, the valuation, they create a very significant impact on your calculations.
So we will talk about that valuation part when we will proceed with this video. We encounter this question from our client as well, that why not my corporation is exempt from reporting in the departure tax and from the deemed disposition like RRSP?
Yeah, like we said, it's the philosophy of it. The government want their share because Canada wants to tax you for all the gains that you have accrued within your corporation. Once you leave, so just to be fair, that they want, if you have gain in Canada, you should pay your fair tax in Canada for those gains.
Means that the private corporation will be treated as a non-registered account. Like if somebody has a non-registered account, that will be subject to deemed disposition. So this will be treated as like a non-registered account, and you have to pay tax when you leave Canada.
That's correct. The shares of the corporation is treated as a non-registered investment, and you pay tax when you leave Canada.
Okay, so how about if somebody has a corporation and he's not sure what is the value of the corporation, how we determine that he has to pay tax on this amount or that amount?
This is the most common and significant challenge that every entrepreneur has, or getting valuation. There is no public valuation on private. You cannot find any price to your own corporation. So there are different ways that you need to value your company based on their future cash flow, based on how capital intensive or not, based on your net profit, EBITDA. So what Canada and CRA wants is to get this fair market value determined by a certified business valuator. And if they think that your value is not correct, you have, a risk of getting reassessed. And if you value a little higher, then you have risk of paying higher tax as well. So it is a two-edged sword. If you try to do your valuation lower, then CRA will interfere or might interfere and reassess and pay and charge you penalties. And if you do higher, then you pay higher taxes as well. So getting your business valued properly is an important key in this matter.
Is there any way they can just not pay tax? Because on paper, this is not an actual sale, but rather a deemed disposition. And if you don't have cash flow, so how come you can pay out of pocket? And especially when you are leaving Canada and maybe you are under stress, especially in financial terms, is there any way?
Yeah, it's very difficult, for entrepreneurs, especially. We always challenged by cash flow when you're running your business, and now you're thinking of leaving and you have not sold anything, and no cash has come, no seller, no buyer, but still you have to pay cash. There are certain provision in the act that allows you to defer the payment. However, you have to provide collateral to Canada Revenue Agency, and sometimes shares of your own corporation or any other asset that you can collateral. But if your expected paying is less than $16,500 up to about $17,000, then they do not take any collateral. In that case, you have to pay, unfortunately.
But usually we have another option where they can claim lifetime capital exemption. How about that option if they can avail in the year of departure or not? And if not, what are the different situations where they can't avail that? If somebody has a complex structure and they have a holding company that is holding the operating company, so in that case, that might be difficult. But what are that option?
Yeah, when we plan our taxes for our clients and in normal Canadian reorganization structure, that lots of clients do have their holding company set up, operating company, and it adds layers of complications too. Because if you own through a holding company, then there is no lifetime capital gain exemption. But if you own your shares personally, because personal do qualify for lifetime capital gain exemption, only if your shares are qualified, you can defer your capital gain up to 1.3 million dollars, which is getting indexed from 2025 for future years, which you can shelter close to $380,000 capital gain if you sell qualified shares.
Thank you so much for sharing this option as well. And when we talk about the qualified shares, mean that at the time of sale, 90% of the company asset by value are used in an active business carried on mainly in Canada. And over the period of 24 months, more than 50% were, and you have held the share 24 months in continuously Canadian controlled private corporation. So sometimes it is difficult for some clients to qualify for lifetime capital gain exemption. So let's move now. If there is no buyer, not an actual sale, it is a deemed disposition, and since you have not sold, how do I pay tax on a company I still own? You have already explained that maybe you can file an election. If you can just give us a little bit more about that election.
Before I answer that, Waqar, this is my plea to our clients that we are saying planning is a key, as we previously mentioned, that in the case of selling shares for our own corporation or deemed disposition, it's a process. It's not a transaction. The shares have to be qualified, and you need at least 24 months period before to make sure that you're thinking right, you're making your shares qualified so that you can claim capital gain exemption. And when it comes to the paying for taxes, you have to pay by April 30th the year you leave. For example, if you leave in 2026, that's when we are recording this in the month of June. If you leave within 2026 by December, you have to pay your taxes by April 30th of 2027. It is a very significant challenge for on the cash flow. So you really need to prepare for it way before when you actually think of moving out of Canada.
Okay, election 1244 is also available, as you have already explained. About if somebody is emigrating from Canada. One thing I would like to add in this, what you have explained, once the shareholder becomes an emigrant, means a non-resident of Canada, your corporation will also become a non-resident of Canada. If you left Canada and you are not supposed to file your tax return in future years, if you don't have any income from Canadian sources. But if you want to keep your corporation active, your corporation will file and will file as a non-resident. So that's something I would like to add in this. And
That's a great point because lots of the time we're thinking that once you're moving out of Canada, we are moving our business too. But what happens is business stays in Canada. And when you go out of Canada and you're the only sole, let's say, shareholder and director, and the mine and management moves with you. So if the mine and management moves with you, that means the mine and management is non-resident now, and your corporation loses its character of Canadian controlled private corporation to a non-resident controlled corporation. And in that case, you lose the small business deduction and it's very significant. So you're not paying the reduced rate of, let's say, 11.5% or 11 to 14% as in Canada, the average rate. You almost pay close to 38% in the general tax of corporation. So that is very huge. And that's where we stress a lot that it requires lots of planning. Before you even move, you need to make sure that who manages your corporation, if you're not dissolving it, if you're not selling in advance, all these things require planning. These are very significant points, Waqar, that a client needs to be aware before they even think of moving out of Canada if they own shares in the private corporation.
yes, and on top, like we have seen that many clients, they have like complex structure. We have already talked. They usually have a trust that holds the operating corporation or the holding co. That's why we always say that the planning is really important. If you are not sure, maybe in near future, you have to leave Canada. So it is always very, very crucial to consult and not have like those complex structures. especially trust. Like if you are young and you have trust, and the trusts are subject to disposition after 21 years, those are the things that you should consider once you have these complex structures in place. Now, moving towards the biggest mistake a business owner can make, we have discussed in our earlier video where we discussed the departure tax. That people assumption mean that they think since it is not a sale, I don't have to pay tax on that. What do you say on this?
Yeah, it happens very often than you think, Waqar. And we have seen in our practice too that people often think that when they're leaving Canada, they just leave by they themselves physically. They don't even think that they own their own shares and they say it stays here and nothing happens to them. But they don't realize that when they actually go, the shares also get deemed disposition and then or deemed disposed. The valuation had to be done and they get surprise letter from CRA asking to pay thousands of dollars just because they didn't do the proper procedure. And they are not qualified shares. And as I said before, there is a process to make your shares qualified. So if that doesn't happen, then you lose lifetime capital gain exemption. Also, if you have not properly recorded the deemed disposition, you get exposed to a hefty penalty and a surprise departure tax on your shares of your private corporation. And Waqar, I would like to add the complexity that you mentioned because in Canadian structure, many family own their shares through holding companies and trust. Though there is a plus side of it, you have lots of tax efficiencies in local when you're in resident of Canada, and you can also multiply your capital gain exemptions to through your family members. But it also adds layers of complexity. And your holding company has to be liquidated. The shares of it, I'm saying, it's gonna be subject to deemed disposition. So again, the planning is a key, Waqar, that in when you think of departing, there is a lot of complexity and departure tax you get exposed to.
So, what I get from all this discussion is plan ahead, which we have discussed in our earlier videos, that planning and not assuming, plan well ahead. In this case, if you have a corporation, maybe before 24 months, if you are planning to leave in 24 months, start before 24 months
Yeah.
before the date of departure, and do not assume, and just try to be on track and do not add complexity to your corporate structure. So these are the outcomes that I am taking from today's discussion. But thank you so much for all of your insight, and we will be discussing a lot more in our coming videos on these and related topics. Thank you so much, Narinder, for your insight.
No, thank you, Waqar. And even I want to summarize for our clients too that do not ever confuse that it's exempt like TFSA, RSPs and all. But this is your owning your shares of within your private corporation is subject to deemed disposition, and planning is a key. And you need to be prepared within well before 24 months in advance to make sure that you are not getting unexpected bill from CRA. So yes, look forward for the next video. Thank you,
Yeah,
Waqar.
thank you so much. Thank you.